All right, guys, welcome back to the channel. So today we are going to review Vanguard's mutual funds, ETFs, and stocks, and I'm going to break down what they are and what I think are good picks for the long term. So let's jump right into it. So first, let's just talk about what an investment product is. Basically, it's an asset that will grow your money for you as a mutual fund or an ETF, which is known as an exchange-traded fund. And when you open an account with Vanguard, you are able to choose multiple investments and hold them all within one account. So the first thing we're going to go over is mutual funds. And mutual funds are a great way to diversify and just have the convenience of dollar cost averaging. You can buy low mutual fund investing and be able to invest either in index funds, which are passive and have lower expense ratios, or you can buy actively managed funds that a manager will manage for you, but they're going to charge you a higher fee for actively doing this. So on the top left, you can see what is a mutual fund for everybody that's a new beginner. A mutual fund is a collection of investors' money that fund managers will use to invest in stocks, bonds, and other securities. So think about, you could have hundreds of people buying this one mutual fund, and then they manage the money and allocate it into the mutual fund. Why are mutual funds so attractive? It's because they have low costs. As it shows, average expense ratios over index mutual funds are 83% lower than the industry average. So when it comes down to it, you really have three options with mutual fund options. What that means is that you can either buy an index fund, which is passively owned, and the reason it's great is because it's low cost index mutual funds, so you're going to pay lower fees to invest in the stock market. The second is you can have actively managed funds, which means that you have an active manager that is picking and choosing and buying and selling, which charges a higher expense ratio. I tend to stay away from actively managed funds. I believe in the Boglehead Vanguard belief that you can just buy index funds like the S&P 500, invest long term, and you will be fine. The next is target retirement funds. I also don't do these, but we will review them at the end of the video for those that are interested, and I'll leave a thumbnail just so you can quickly zoom in on that if you want to learn more about target date funds. So we clicked under index funds, and we're going to look at the Vanguard mutual funds. These are all index funds that are passively owned. And the first thing we're going to talk about is it will show the symbol, which is the symbol that you would type in if you wanted to invest in this product. Now they start off with their strongest one, which is VFIAX, which is the 500 index admiral shares. Sometimes these names will be different. It just invests in the S&P 500. You know that because it'll show the asset class as a stock and large cap blend. Now, when you are comparing index funds, you have to look at the expense ratio. The expense ratio is expressed as a percentage. All this means is what are the fees that are charged to the investors, meaning you, for buying that index fund, that actively managed fund, or that ETF. These are the operating costs. They are deducted from the dividend and the capital gain distributions, but not the principal. So learning to navigate this website, what I like to do is use the filters. And let's go through all these real quick, just so you guys can get a good idea here. So when you go through this, you can click on strategies and you can say, okay, well, do I want an all-in-one? Meaning, do I want a fund that encompasses basically everything in the market, like a total market index? So when you click all-in-one, you can see that it just brings up right away these four funds. So now you're looking and you can see that you have the other filters to choose from. We went through the strategies where you have all-in-one, total market ETFs, and ESG. Now you can click on the management style, and that is either active or index. I just want to show you real quick. Focus on the expense ratio here. If I click active, look how high these expense ratios are because we're having them actively managed. 1.83%, 1.77%, 0.78%. Now let's click off the active and let's click on index. Notice how the index is much cheaper. Look at this, 0.2%, 0.2%, 0.2%. Much lower because it's not being actively managed. This is why I lean towards index funds when I'm going to invest. Let's leave the index fund on. And what we're going to do is we can see the filtered by, we only have index on right now. And now we can go by asset class. So clicking on asset class, you can pick either stocks, fixed income, money market, balanced, or sector. So we'll leave that as is for now. And we'll go to, actually, let's go to stocks, just so we can make sure we get the fund that we actually want to show. So when you click on stocks, this gives you another option. You can pick large cap, which means that usually the companies have over, 10 billion in assets. Mid cap is in between usually 2 and 10 billion, and small cap is less than 2 billion. Next, you have value, blend, and growth. When you think growth, I want you to think of companies like Tesla, PayPal, PLTR, companies that are new and they're trying to grow. Value, I want you to think of like Pepsi, Coca-Cola, CVS. They offer dividends, etc. Now let's scroll down. You can go to risk scale, and you can do this if you want, where it'll have the risk scale of 1 through 5, 5 being the most risk. And we're definitely gonna go most risk. We want to see what we can find with that. And we'll see what Vanguard rules as their riskiest. You can also do minimum investments. What is a minimum investment? All this is that it's a range of minimum investments available to meet the needs of all the investors. So that means you need a certain amount just to buy this fund. So let's say you had an ETF and you buy an exchange for as little as $1, which is great. Now, it doesn't matter what the ETF share price is. If the ETF costs $400 and you put $10 in, you're going to buy, $10 worth of the 400. You won't have one share, but it'll eventually add up to that once you put more money in. We're not going to put a minimum investment. Next, you have share classes, which is investor shares, admiral, and institutional. So let's go and dive into a fund, and let's break down the first fund that I think would be an excellent start to your investing journey. The first fund that I think everybody should have in their portfolio is the cornerstone of any investments, is the Vanguard 500 Index Fund. This is the S&P 500. This is the Vanguard's version of it. VFIAX. It's an index, so it's passively managed. It's domestic, meaning it's in the United States. Its expense ratio is 0.04%. And as we said, the expense ratio is just fees charged to the investor to cover a fund or ETF's operating costs, and they are deducted from the dividend and capital gain distributions, but not the principal. Next, you need a minimum investment of $3,000. Although I know that may seem hefty, it's a great start, even if you can just save up to get to the $3,000 and then start buying. This means that you need to start with $3,000, but after that, you can contribute $10 a month if you wanted to. So you just got to get up to that minimum $3,000. And the NAV price is $470 a share. Now let's go to the overview and let's break it down, because I want new beginners to understand what this fund is. We kind of went over what this was, the management style, S&P 500, but this is what you want to look at. Year to date, we're up 6.91%. That's great. We're only in February, so that's an excellent return so far. And average of a good fund is about 8 to 10% a year. So you're almost there already, and it's only been 2 months. So this says that this fund is the 500 index, and it's a low-cost way to diversify in the U.S. equities market. So when you're buying VFIAX, you are buying the S&P 500, meaning the United States top 500 companies, and you're buying all stocks. So it's 500 stocks of the largest U.S. companies. All right. Next, fund management is Vanguard, because that's the website we are on. Let's go to performance and fees, because like we said, we'd like to look at the annual. So let's look at cumulative. And if you were to hold this fund for 1 year, you made 20%, 3 years, 36%, 94%, in 5 years, and in 10-year span, 226%. That is an excellent return. And a next thing to look at is, when was this fund created? So this fund was created, inception, so that's when it was created, in the year 2000. So if you bought in 2000, you're up 456%. That's incredible. Next, your expense ratio, like we said, VFIAX, the S&P 500, the index admiral shares, 0.04%, which is basically nothing, which is a great way to start your investing journey. The price, it is $470 a share, but don't worry about that. Once you meet the minimum $3,000 to invest in this, you can buy $100 a month if you wanted to, or even less if you wanted to. You can buy fractional shares of it. Next, you have the historical prices. It's always good just to see where it started. And it used to trade at 100, and this 2014 is the farthest it's letting me go back. You used to be able to trace at $171, but over time, just look, just dollar cost averaging 2015, 190, 2016, 200. And as you can see, from 2019 all the way up to 2023, it doubled, 447. So it is definitely growing over time, which is excellent. Now, why do I think this is one of the greatest funds ever to invest in? Look at the portfolio composition. I love the nice balance. You have a large blend, all right? And what does that mean? That means we have 505 stocks within this. And the PE ratio of the cumulative of all the 500 stocks is 24.2. And next, let's look into the actual weighted exposures. This is why it is so dominant, is because it has a nice equal balance between all of the sectors. Sectors means for newer investors is where are the stocks allocated. So you can see in communication services, you can see here as I change and I scroll through, it'll show the percentage. Communication services almost makes up 8.9%. Consumer discretionary 10%, staples 6%, energy 3%, financials 13%, healthcare 12.8%, industrials 8.6%, and then information technology is the largest portion. Look how much bigger it is compared to everything. It's this huge red bar right here. As you can see, it makes up almost 30%. These are your Microsofts, your Apples, the big guys like that. Now we can get more specific, go into the holding details, and this is what you need to look at when you're looking at any index fund. What are the holdings that make up of this? So as you can see here, you have Microsoft as the top dog, you have Apple, Nvidia, Amazon, Meta, which is also known as Facebook, you have Google with the L shares and Goog shares, you have Berkshire Hathaway, Tesla, and AVGO. These are the top dogs of the companies. This is what makes up most of the S&P 500, the 30% allocation out of 100 for them. And then it shows you distributions, your realized, unrealized gains, which I wouldn't focus too much on that for now because you need to have shares to really, it'll show it on your actual portfolio when you own it. And then dividends, what it's paying. So as you can see, this is 2023, 2022, you're getting 4 dividends a year. And they usually pay quarterly, which means March, June, September, and December. And as you can see, the dividends have been going up. You went from $1.48 to $1.57, $1.49 a little down to $1.80, which is nice. Now the fund management, as we can say, it invests in what's called, when I say S&P 500, it just means Standard & Poor's 500 index fund. And all that is representing the U.S. large capitalization stocks. That's all it is. And these are your portfolio managers that are managing this S&P 500. Now, it's an index fund. It's just passively investing in these companies. So you're going to have low fees at that 0.04% expense ratio. All right, guys. So the next fund that I am recommending is a growth index fund. I have a similar fund in my Fidelity, which is VSGAX, but this actually is a lower expense ratio and invest in the very same or similar companies that I do for growth long term. What you're going to realize is that this is similar to the S&P 500, except the top 10 holdings make up about 50 to 55% of the whole index fund. So let's break into it. This is a growth fund, Vanguard's VIGAX. This is large growth, so large companies. They have billions of assets, 0.05% expense ratio. Just so you guys can review it again, the expense ratios are fees that are charged to the investors, meaning us, and is deducted from our dividend and capital gain distributions, but not the principal. The NAV price is $174 per share. Let's go over the overview. As you can see, year to date, we are up 8.99%. This is an index fund. It is passive. It just invests in those stocks. Let's break it down even further. This fund invests in large U.S. companies in market sectors that tend to grow more quickly than the broad market. So what that really means is it's going to be heavily weighted in technology. So that is definitely very important. Next, let's scroll down. Let's look at the cumulative performance and fees. Over 1 year, it's up 35%, almost 36%. And in 10 years, up 289%. So it's up. These swings are a lot larger than the previous fund that we did, which was the S&P 500. You will see in this fund, you will have drawdowns that are much more aggressive, and when the market's going up, it's going to rally much more than other ones. This expense ratio is incredible, 0.05%, super low fees for getting a great, variation of investing in the market. As you can see, the price is $174 per share, and let's look at the 10-year performance of this. Just to give you perspective, it's now trading at $163. Well, it's really $174. I guess it didn't update. And it used to trade at $49. So if you bought this 10 years ago, $49 up to $174, you have tripled your money. So definitely an excellent investment. Portfolio composition. What this is what is the fund made up of? So a number of stocks is 208. So there's 208 stocks that make up this, that you're paying that 0.05% ratio. The PE ratio is 35.6. Let's click on PE ratio. What this means is the price to earnings ratio. It's the price per share of a stock divided by its per share earnings over the last year. So for a portfolio, the average ratio is weighted against the average price earnings ratio of the stock it holds. So now let's scroll down. I want to show you the weighted exposure because this is very important. You're going to notice some sectors are much less than others because they don't have as much growth. Like look at the basic materials. It is 1.3%. Consumer discretionary, almost 20%. Industrials, 8%. But what I really want to highlight is look how big this orange bar is. This is technology, and that's what's going to make up our holdings. Technology is almost 56%. So let's go into it so you can really take get a good look and understand why it's investing so much. So VIGAX is investing in heavily, 55% in Microsoft, Apple, Nvidia, Amazon, Meta, Google, Goog, LLY, Tesla, and Visa. So 55% of this fund is all in just these 10 stocks. So you have to, be a believer in these 10 companies that pretty much run the world, and that's what you're investing in when you buy this fund. Now I own a similar fund in my S&P and my Fidelity, which is VSGAX, and I'll post that video at the end so you can check it out if you like Fidelity more than Vanguard. Dividend income and capital gains, you're not getting much. You're getting dividends quarterly, March, June, September, and December, but they're much lower, 29 cents, 18 cents, 20 cents, 21 cents. And the reason is because you're trying to get growth here. You're not going for dividends here. So fund management, it seeks to track, so it tracks the CRSP, aka the US Large Cap Growth Index. It's unmanaged, meaning it's passive, and it's just passively following those top 10 companies and the rest that make up the 208 within this. So the third fund that I'm recommending is VMGMX. If you want mid-cap growth, meaning that you're going to get companies that are no longer in the large cap, so everything that we listed in the first two funds is not going to be in here because this is mid-cap growth. So this is VMGMX. It invests in the S&P 500 mid-cap growth companies. So that means the expense ratio is 0.07%, minimum investment is $3,000, and it costs $97.53 per share right now. So let's go over the overview of it. As you can see, it says domestic stock, which is more aggressive. So it's going to say low-cost index fund that invests in the U.S. growth-oriented companies, and they grow more quickly than medium-sized companies. So this is still high growth. They're mid-sized companies. They're proving themselves, but they're still trying to get out of that and get into the large funds. But what you need to know is that when it comes down to these guys, they're more riskier. There's definitely more volatility when it comes to mid-cap stocks. So you need a strong stomach for this. This is a dollar cost average strategy over the long term. Let's look at the cumulative performance and fees. If you invest 10 years ago, you'd be up 163%, which is still an excellent return. Expense ratio to own VMGMX, you are paying 0.07%. We went over that. The price, as you can see, $97. I want to give you some perspective here. If you owned it 10 years ago in 2014, it was worth $40. It has went all the way up to, 97 was the last price that it was showing. So you essentially doubled your money. This is a good way to diversify your portfolio if you don't just want large cap. So when you look at portfolio composition, you really got to look at, remember the S&P 500 and the growth funds were this box and then this box. Now your market capitalization, what the companies, how much billions they're worth, as you can see, are made up in mid, which shows these companies, the medium is 30 billion. So out of these 150 stocks that are within VMGMX make up 30 billion in assets. Now the earnings growth rate is the average annual rate of growth in earnings over the past 5 years for the stocks in the portfolio. That's 18%. The PE ratio is 26%, which is the price per share of a stock divided by its per share earnings over the past year. So for a portfolio, the ratio is a weighted average price earnings ratio of the stock it holds. Now scrolling down, I just want to show you the percentage over here of the weighted exposures. As you can see here, basic materials, only 1.7%. consumer discretionary 13%, consumer staples 1.9%, energy 6%. As you can see, the biggest areas is industrial at 20%, technology at 24.7%. Now let's look at the holdings and look how different they look, because the other companies like the Apple, the Tesla, they're all large cap. They don't qualify for this mid cap growth index fund. So when you're buying this, you know you're getting different stocks, which is what I like. So they have ANET, which is Arista Networks, APH, which is Corp Class A. You have this. What I like is it has Realty Income in it, which is a Dividend King, which I own personally as just an individual stock. And they also have MSCI. So you definitely have a different mix of stocks in here. It might be stuff you've never seen before. You might not, be aware of them, but that's why it's good to look through these and get a good investment diversification. If you truly want a diverse portfolio, it's good to go large cap, mid cap, and then potentially small cap if you have higher risk. Now let's go to fund management. It's a mid cap growth index fund, and it tracks the US mid cap growth index, and it's unmanaged, and that's why you get those low expense ratios at 0.07%. So I just want to show you how I found those companies. So I used the filters over here. Large cap was where we found that S&P 500. Then I clicked mid cap, and mid cap came in with the VMGMX. Now, if you were interested in, let's say you wanted something a little smaller, you can do small cap. So I click small cap, and then look at this. We're going to look into our next fund that we're going to talk about. And the institutional shares, we can't buy those because the minimum investment is $5 million. And I'm sure if you're watching this channel, you probably most likely don't have $5 million in assets. And if you do, that's incredible. Leave a comment in the section below. I definitely want to see that. That's incredible. So VSGAX, admirable shares is what we're looking at. 0.07% ratio. The risk is 5 out of 5. And invest in small cap, large growth. So let's go into it. Let's break it down. VSGAX, which is very aggressive. This is like one of the most aggressive you can do. This is risky stuff. You got to hold on to it long term and then ride the waves. So VSGAX, small cap growth index admiral fund. You need a minimum investment of $3,000, 0.07% expense ratio. It is $87 a share. Let's look at the overview. It's going to glitch as I go down. The year to date so far, it's only been 2 months, is 2.64%. And this is a low-cost index fund that gives you small capital U.S. growth stocks. So just to give you kind of an idea, like in my 401ks, I own about 10% of my portfolio. My 401ks is in a small cap growth fund. Just to give you an idea, the S&P 500, that first fund that we reviewed, would be about like 80% or 75%. The mid cap would be 15%, and then the small cap here would be 10%. Just so I can cover all the areas long term. Performance and fees, let's look at the cumulative. If you were to buy this 10 years ago, you would have made 109%. So in 10 years, you doubled your money. So not a bad investment. You just got to think long term with these funds. That's the biggest thing. If you're just holding it 1 year, you're going to get really big changes. So as you can see, $82 in 2024. Let's move it to 10 years. 10 years ago, it cost $44. And then it went to $82 at a high of almost 100. So you definitely have a lot of volatility with this. So you really just want a dollar cost average. I love how they show this box, because this shows you with the VSGAX, you're getting growth, but you're getting small cap, which means that, look, the companies are only worth a cumulative of $7.4 billion. The PE ratio is 27. And let's scroll down and look at some of these assets. But what I like about this, it shows Vanguard likes to allow you to know that this is a very aggressive fund. So this is classified as an aggressive fund, and it's subject to extremely wide fluctuations in the share prices. This is high volatility, and you have to really have a good stomach to hold these funds, or you have to have a long-term outlook and just buy it every week as an automatic investment and don't even look at it, because it's going to grow over time, but it's going to go up and down and left and right. So as you can see, what makes it up, consumer discretionary is 16%, healthcare makes up 17%, and technology is 23%. So it's going to be very volatile. Take a snapshot of this if you want to see it. I'll leave it up just for a second while I'm talking, and then we'll scroll down and we'll look at what else it offers. So look at the holdings. The only company that I recognize is SMCI, and that's because it's been so popular in the news lately that it's Super Micro Computer Inc. It has 632,000 shares involved within this. And these are your top 10 companies that make up the small cap. So now let's scroll down and let's look at the dividends. You are getting quarterly dividends. Look at 2023. You have March, June, September, and December. And about 11 cents, 13 cents, 11 cents, 21 cents. So not bad. The investments are the dividends are small, but the fund management, it has small cap growth index fund tracking the US small cap growth index, and it's unmanaged, so you have lower fees like we talked about at the 0.07%. Now let's look at an international fund so you can get an idea of something outside of the United States. So this channel is about navigating the Vanguard website. As you can see, I'm still under these filters, and instead of US, I'm going to click international now. So now I click the international box, and now I'm going to get a different choice here of funds that I can pick from. And you can do overview, you can do performance, so you can look at the performance of them in the 1, 5, and 10 year, and you can look at the price if that matters to you. So let's go by the performance first, and then let's go through it. So we're going to find which fund to pick through by looking at it. So starting with the overview, we're going to go by the expense ratio. This is the lowest one at 0.04%. And it goes all the way down to, let's scroll down, it goes all the way down to 0.2%. That doesn't mean just because it has a high expense ratio, it's a bad fund. But for me, I'm dollar cost averaging over time. That can really eat at your returns. And let's take a look. This is institutional, so we cannot buy this one anyway. This is institutional, we can't buy that anyway because you need that minimum investment of $5 million. We are going to look at the admirable shares because this is more our style with the minimum investment of $3,000. So looking at VTMGX, you can see this is the Developed Markets Index Fund admirable shares, and this is international stocks only. 0.07% expense ratio, $3,000 minimum, and it costs $15. So let's look at the overview on this. Year to date right now, it's February 2024. We were up 1.88%. This index fund is involved in low-cost, diversified exposure to large, mid, and small cap. So the first three that I showed you were large cap, growth fund, then I showed you mid cap, then I showed you small cap. This is international, outside the United States, and invest in large, mid, and small cap companies. So this is really cool that you get the all-in-one for international. And its focus is non-US stocks. So Vanguard is telling you that this can be more volatile than a domestic fund, meaning a United States fund. So just keep that in mind. We need another strong stomach for this. Minimum investment $3,000, cost $15 a share, expense ratio 0.07%. Let's look at the cumulative funds. If you own this for 10 years, you made a 61% return. So not bad, but not as good as just investing in the S&P 500. And that's why I tell you, I really believe the S&P 500 has to be the cornerstone of your portfolio. That's your long-term growth that you buy, which was the first fund that I showed you in this video. So refer back to that if you need to review it. Now, the expense ratio is VTMGX is very small, 0.07% compared to the average of 0.9%. So we know we're getting some discounts there, which is nice. We reviewed the price. Let's look at the historical 10 years. It was $13 10 years ago, and it's about $15 today. So you're really relying on those dividends to get good growth on it. Looking at the portfolio composition, this fund, VTMGX, makes up 4,000 stocks within any company outside the United States. So internationally, you got 4,000. It's almost like a total market index, but it's for the international. You have 39 billion in assets. PE ratio is 13, so very low. That's good. And now going over the weighted exposure, because it's international, it's going to show you which regions it's investing in. So Europe makes up 53% of this fund, whereas Pacific makes up 36%. Middle East is 0.6. North America is 9.6. So here we go. These are the holdings. Some of them look familiar. Nestle, Samsung, Toyota, Shell, and maybe you know some of the other ones. That's what it's investing in. Next, you have your dividend income. It does pay quarterly. You have March, June, September, December. So you get in quarterly dividends around 19 cents, 9 cents. It varies, 13 cents and 5 cents. So definitely varies there. And then your fund management, it just shows that Vanguard developed market index fund. It tracks all developed ex-US index, so anything outside the United States, and it has a market capitalization weighted index. So that means each fund is equally weighted, which is nice, out of 3,700 common stocks. And that's your international fund. All right, so next we're going to talk about ETFs. ETFs are excellent because you can buy and sell these within the same market hours. So the market hours could be from 9:30 to 4. You are able to trade an ETF just like a stock. You can buy and sell it, and that's what makes it more attractive than a mutual fund in terms of liquidity. So I'm going to go over the I'm going to go over 3 funds because there are 3 funds that I think are very useful that are very similar to the index funds, but some people just like trading ETFs or having it long term. So I clicked on stocks and I left these blank for now. And as you can see, we have VOO, and this is a cornerstone of one of my portfolios. I hold this in my actual Fidelity account, but Vanguard owns VOO. So VOO is the S&P 500. It's just another version of it and has a 0.03% ratio. I think this fund is excellent, and I think this is something that if you're going to go ETF S&P 500, VOO is all you need. You can dollar cost average into this over time, and this is great. So I'll do a quick review because it's very similar to the mutual fund, but this is an excellent fund to own. It's index, large cap, 0.03% expense ratio, so super small, and it's cost $466 a share, which is excellent. Next, the year-to-date returns are 6.86%. It invests in the S&P 500, representing the top largest U.S. companies, which is 500 of them. And its goal of VOO is just to closely track the index's return. And that's why the fees are so low at 0.03%. That's why it is such a valued ETF that people own long term. 10 years, you had a 226% return. And look at this expense ratio, 0.03% compared to 0.79%. So excellent expense ratio. You're barely paying anything to own it. The portfolio composition makes up the S&P 500, so it's going to be the 500 companies. It's going to be in this blend. And as you can see, we're seeing a common theme here. The blend, large cap, S&P 500, very simple. It has a very strong asset allocation of 29%. And the information technology, consumer discretionary is 10%. What I want to show you is same as S&P 500. You have the Microsoft, the Apple, NVIDIA, Amazon, Meta, Google, Berkshire, Tesla, and AVGO, the same as the first fund that I showed you as the mutual fund. So excellent ETF to invest in, just a different investment vehicle being an exchange traded fund. VOO is an ETF, so remember that. You can easily buy and sell this throughout the day if you wanted to, but you can also hold this long term. It's a great long-term investment. The next ETF that is worth mentioning is VTI. This is the Total Market Index Fund. It's right here, VTI. It invests in large cap blend, 0.03%. And let's break it down because I think this is a great ETF to buy long term. VTI is an index management. That means that it is passively owned, and that is why you get such a low expense ratio of 0.03%. It costs $251 a share, and it is domestic stock general. So just the overview of it, it seeks to track the U.S. total stock market index. So you're going to get large, mid cap, and small cap. Unlike in the previous index funds I was showing you where one was dedicated to large, one was dedicated to mid, one was dedicated to small cap. This specifically involves all 3 of them, and you're going to see that it holds a lot more stocks within one. It's passively managed. That's why the expense ratio is low, and it minimizes track error. So let's go to cumulative. If you own this over a 10-year period, you made a 208% return, which is excellent. And its expense ratio compared to everywhere else is 0.03%. And the average is 0.79. So you're getting an excellent expense ratio and a good discount just for holding it. So you're not really worried about fees with this. Market price costs $252 for VTI. And then if you look at the 10-year performance of it, $97 all the way up to $239. So that's excellent. Here's a table version of it where you can see 2014, $97. And then if we were to scroll through the 120 pages, we would have got to that $210 worth. So let's go over the portfolio composition. As you can see, large cap blend, but it holds 3,700 stocks within it. So VTI has 3,700 stocks in it. PE ratio average is 23, and the market cap is 152 billion. I just want you to see this asset allocation because I think this is important. You can see the sectors. Consumer discretionary makes up 14%, financials is 10%, industrials 12%, technology is a huge percentage at 31.9%. So definitely something to consider there. But this is the total stock market index, VTI. It holds Microsoft, Apple, Nvidia, Amazon, Meta, Google, Goog, Burke, Lilly, and AVGO. And then scrolling down, you can see the dividends where you receive $1 a share, 79 cents a share, 82 cents a share, 78 cents a share, and that's all in the quarterly, which is March, June, September, and December. So you're getting great dividends from it. And it invests 100% of the money into U.S. stock, including large, mid, small, and micro cap that are regularly traded on the New York Stock Exchange and the NASDAQ. So definitely a great overall fund. You can honestly just pick this and run with this. This is very similar to the S&P 500 fund, except it has 3,700 stocks within it, and you get a great diversification. This is pretty much all you need in one right here. If you just chose one ETF, it's either the index fund VOO or just VTI, and just run with it. All right, so the last ETF that I think is worth mentioning on Vanguard's is VUG, which is the growth index fund. Growth ETF. This growth ETF is excellent. It is all about like that last index fund that I showed you that has growth potential, but it's the ETF version. So you can buy and sell this within the same day. They're very liquid. VUG is the ticker symbol. It's an index, domestic stock related, 0.04 expense ratio. It costs $338 a share. When you go over the overview of it, it just tracks the U.S. Large Cap Growth Index Fund highlighted on the right side, and it's passively managed, and 75% of its total assets make up these growth companies. So let's take a quick look. Let's scroll down to the performance and fees, and we are going to see very high performance here. So look at the last 10 years, up 289%. So this is a fund that I think is definitely worth your bang for buck if you're trying to really have a concentrated portfolio on growth stocks. So VUG is your growth ETF at 0.04%. I just want to go over the portfolio composition for you to see. Similar to that other mutual fund, the number of stocks, 208, VUG. It has 613 billion in market cap. The PE ratios are high because it's a growth company, growth ETF, which is 35%. As you can see, it's highlighted in the growth section, large cap companies in growth. I want you to see the funds are going to be very similar to what we just reviewed, except the concentration is much higher in Microsoft, Apple, Nvidia, Amazon, Facebook, Google, Lilly, Tesla, and Visa. You're not going to get much dividends with these. You're getting 58 cents. It costs, $300-400 a share right now. It's hard to build up that many shares unless you just keep dollar cost averaging over time. So the dividends are definitely a little bit less, but you're going for growth. But this is definitely a good alternative if you want a U.S. large cap growth index fund as an ETF. And it has low fees. All right, so next I just want to show you target retirement funds. I just want to show you what they are. I don't invest in them. I think they're completely useless, to be honest, but for some people this makes it easier because they're scared to invest. So let's look at the target retirement funds that they offer, and I'm going to show you why I don't like them. So we're going to click on the Vanguard mutual funds and ETFs, and we are going to look for a target date fund. So these are your target date funds. As you scroll down, you will start to see 2020, 25. Anytime you see the year, and it goes by 5 years every single time, those are target date funds. That means they automatically buy and sell for you, and they reset your allocation based on how old you are. So let's just do the VSVNX Target Retirement 2070 Fund. So that's about 40, 50 years from now. You have VSVNX. It shows you expense ratio 0.08%, and you can invest in this long term if you want. But I'm going to show you why I don't like it. Because I just believe that why would I want to pay higher fees at 0.08% for similar funds that I've already shown that you can get a good mix and pay less fees. So this offers a diversified portfolio. It's a single fund that adjusts its underlying asset mix over time. So that's different than everything else I showed you. Over time, every 5 years, it's going to rechange the allocations. So if you have this in a taxable portfolio, you're going to have to pay capital gains every time it sells these assets and moves them into another one. So that's another reason. You're getting hit with a tax burden every single time. And over time, you're going to get more bonds, which I don't want personally. I like to have mostly stocks as my portfolio because I want growth. But if you held this for 10 years, you get 127% return. Your expense ratio is 0.08%. There are no fees with this as long as you're a Vanguard member. There's no purchase fee, there's no fund family redemption fee, and there's no 12B-1 fee. I'm not sure what that is, so let's look at it. It's an annual fee charged by some mutual funds to pay for marketing and distribution activities. So if you see this 12B-1 fee, that's just a marketing fee, but you don't get charged that. Let's go into the historical 10 years from now. It started at $19. It went all the way up to $23. Now this invests in basically a pool of index funds. So this VSVNX will invest in the total stock market index fund, 53%, the Vanguard International 36%, and then the total bond 7%, and then the international bond 3%. And over time, this will change. And let's see if it shows it as we go down. So right now, the asset allocation is 89% stock. So when you buy this target date fund, 89% of your money is in stocks, 10% is in bonds. So that's definitely still a good benchmark. Let's say you're 20, 30 years old. That's not terrible to have 10% of your money. I wouldn't want 10% of my money in bonds, to be honest, but I would definitely try to have more assets in stocks. Next, it just shows your fund management. It retires between 2068 and 2072. Now remember, as time goes on, this fund is going to be more concentrated in bonds. So as it gets closer to 2070, your bond allocation is going to look like this with the stocks. It's going to be much higher. It's going to be like 70 to 80% bonds. So this was a good recap of just starter index funds that you could do long-term for the Vanguard website. I noticed that if you scroll down over here, you are able to get helpful resources where if you want to learn how to invest on your own, you're watching me on YouTube, you want to, do-it-yourself resources, you want to get professional advice, you get other investment products. Guys, I don't get paid by Vanguard. I just do this because I love talking about stocks. So this is just stuff that you can scroll down on the bottom. You can frequently ask questions, and it can teach you basically more about stocks, what's NAV, what's the difference between active and index fund, and how do you decide which one to pick. So they have different options for you. So I think it's just good to mention in this video in case you're trying to learn a little bit more for yourself. There's good reading material on the bottom of the Vanguard website. All right, guys, so I just want to say thank you for tuning in. If you made it this long, I really appreciate it. Please subscribe, like, leave a comment. This is my channel, Trading Simplified. We're starting to grow. We're getting more subscribers. Check out my playlist. I got my Trading P&L, Investing for Beginners, my P&L for 2023, Taxable and Fidelity portfolio. I have the Fidelity Active Trader Pro that I use when I day trade, and just different investing ideas, long-term investments. There's definitely a lot on this channel that you can learn from. Please subscribe, leave a comment, and until next time, thanks for watching.